We had a guy who was linked with a Lithuanian people smuggling gang.
You're the director and principal and co-founder of Avamore Capital, an award-winning specialist real estate development and bridging lender, and lend close to $1 billion now in funding.
We're funding deals mainly through mine and Zaher's family offices. Attracting capital to work alongside us and go into deals was actually relatively easy. At the moment, solicitors are really winding me up. Service levels are poor, very slow. Fees are getting out of control. We're 6 weeks away from front to back, end-to-end semi-automation within the business. I know Zaher wants to get to $500 million.
Money loves speed, it hates friction.
Time kills deals. We have sadly had to make people bankrupt. The developer doesn't necessarily know how to package the deal for a credit committee. If you get made bankrupt, that can be very difficult in your onward entrepreneurial journey.
Property, it's a capital-intensive game.
You know, working with a lot of early-stage developers at Avamore, the guys that come in, they burn really hot, and then they go, and then they're done, right? The last thing you want is...
Before we kick off the episode, over 72% of you have not yet hit the subscribe button. So I would ask you a small favor. If you enjoy the content, if you're enjoying the conversations, you're liking the interviews, then please hit that subscribe button. It's absolutely free. And my promise to you is that we will make the channel better, the interviews better, the guests better, and we'll listen to your feedback and make sure we improve every single time. Now, back to the show. Hello, everybody, and welcome to another episode of Property People. Today, I'm delighted to be joined by Mr. Michael Dean. How are you today, Michael?
I'm good, Sam. It's great to be here.
Thank you very much for coming on the maiden day of our new studio that we've got here in Hampshire. Michael, before we jump into having a good discussion about everything to do with property development, lending, and everything else, I'm going to do a quick intro because you've got a very interesting story that's made you arrive to this point. You're the director and principal and co-founder of Avamore Capital, an award-winning specialist real estate development and bridging lender of whom Merry Oaks, our finance brokerage, works very well with, and we work with as brokers. Avamore has supported over 500 developers and investors, delivered thousands of units across the UK, and lent close to $1 billion now in funding in the UK property market. And to achieve this is there's no small feat. I've been heavily involved in the lending space for the last 10 years or so. I can't wait to find out a lot more. How are you today?
Hey, I'm pretty good, thank you.
Good. Right, so we've actually done this before. I was answering the questions, and now I'm very excited because I remember actually we could have talked a lot longer then. So this is my chance also to ask you a bunch of questions. But before we do all of that, I'd like to start to get to know you a little bit better.
Okay.
And who were you at school? What type of person were you? Were you studious? Were you mischievous? Did you enjoy school? Did you hate school?
I was sometimes studious, sometimes mischievous. I wasn't super popular at school. I was in the year ahead of myself. I was a bit awkward, a bit socially awkward. Some would say I still am, especially my wife.
She tells you, yeah, regularly.
I think I was always I was naturally quite a good student, but I think I became a bit rebellious in my teenage years, and so maybe the old GCSE results and A levels didn't reflect my academic abilities. I very much enjoyed the sports field. I was at a boarding school in northwest England, and which I didn't really like. I would much rather have been in my home in the southeast, enjoying warmer, drier weather, dry football pitches, dry rugby pitches. But at the end of the day, it was a formative experience, and certainly for better or for worse, shaped the person I am today.
Did you go to university to get a degree or anything?
I did it twice actually. I got a degree in chemistry from the University of Bristol, which is where I met my wife and some of my happiest times. And then I did another year doing a master's at the University of Reading, where I did a MSc in real estate investment, and that particular course is tied with the Henley Business School. And Reading's actually proved to be a real happy hunting ground for Avamore, where two department heads that we've got now went and did the real estate course. One did a bachelor's, the other one did a master's. so head of underwriting, head of transactions, both there. Former co-founder also did real estate at Reading, and I think we'll continue to dip into that well as the years go by.
Interesting. So you weren't that bad at academia. You said you could have maybe done better if anything, but you must have been. I mean, for anyone to get a master's is, I think, is some feat. But the jump between chemistry to real estate, where did chemistry come from?
Well, I think it's more that so my mum and my stepdad both had PhDs in chemistry. My mum actually worked as a pharmacist as well, so she also went down that route. But so we're kind of quite academic parents, and I did 3 sciences at A level. Science was always they were just the subjects I did best at.
Really?
I never really thought I was going to do a career in science, but I just knew that if I was going to do 3 years at university, something academic, I knew that chemistry would be the one subject that I knew I'd be able to get through without too much difficulty.
As in, you found it easy, chemistry?
I found it quite naturally easy, yeah. I had a bit of a rude awakening when I went to university, and I nearly got kicked out after the first term because I was enjoying myself way too much and not studying hard enough.
Right.
But I knuckled down, and I got 2-1. So although that was kind of by the skin of my teeth. Again, enjoyed myself a little bit too much in my second year, and had to do a lot of catching up in the third year to get my grades to the right level.
Out of curiosity, has chemistry helped you at all in your?
No, not remotely. I've forgotten all of it as well.
Really?
I've forgotten all of it.
Fair enough. So from chemistry to real estate and doing the masters, were you working at any time during that, getting any work experience, or was it purely just doing the academia?
I did a bit. A client of my mother's at a pharmacy. He had a surveying practice in the West End, and I got a couple of weeks of work experience with him, and they liked me so much they actually wanted me to go and work there. But I, being the egomaniac that I was then, and probably still am now, felt that was beneath me, and I wanted to go to work for a big company and do something a bit more glamorous and sexy rather than working above a garage in a Muse courtyard in the back end of Mayfair. So that's where I ended up at going to Cushman & Wakefield after my year at Reading.
And Cushman & Wakefield, for anybody that doesn't know.
So Cushman & Wakefield is, I would say, probably the 3rd largest global real estate consultancy in the world. When I joined them, they were actually called Cushman & Wakefield Healy & Baker. So Healy & Baker was like a old school, blue-blooded West End surveying practice. When you say surveying, really what it means is commercial agency, but also doing advisory work such as landlord and tenant and valuation work. And Healy & Baker was acquired by Cushman & Wakefield. Cushman & Wakefield was at the time a large US organization, and we were seeing we're talking about just over 20 years ago. We saw a wave of sort of traditional blue-blooded West End surveying practices being acquired by American companies. So Jones Lang LaSalle was previously Jones Lang Wootton, and they were acquired by LaSalle. CB Richard Ellis was previously called CB Hillier Parker. They were bought by Richard Ellis, again, US-based companies. So the Cushman acquisition of Healy & Baker kind of followed on from that. So I joined them in 2004.
And what were you doing there?
So I was on their grad program, and I worked in retail warehouse rent review in the first year, and for those that don't know what rent review is, effectively in commercial leases there's often a provision in the lease that every 5 years the rent will get reviewed, generally upwards only for the landlord's benefit, and the landlord surveyor and the tenant surveyor will have effectively a virtual arm wrestle as to what the rent should be. And if they can't agree what that rent should be, they then go to an independent expert or an arbitrator who then decides what the rent should be for the next 5 years and the remainder of the lease thereafter. My job was rather dull. I spent most of that year making cups of tea, doing binding, and pestering agents in the leasing space of retail warehousing, which was really in its heyday at the time, to get rental comparables. And a lot of the time, because I was getting something from them, but I had nothing to give back to them in return. Can I swear?
Absolutely, feel free.
They'd often get quite pissed off with me because they're like, "Why do I need to speak to you, you little oik? You're not giving me anything back in return." So, so it was quite frustrating. So I was really grateful at the end of that year to go and move seats, and I went and worked in the city office agency. So there was actually a city office, satellite office. So the main headquarters of Cushman's still is at Portman Square, and I got to work on Cannon Street, which ironically is where I work now as well, which is on the same road a few doors down, where Avamore's offices are. But so we got to be in this cool little satellite office, had way more autonomy, and I got to do deals. I mean, I was literally out. I was basically, there was no training. It was like, look, there's some brochures. That's the address of the instruction. Here are the keys. Go and so and so wants to go and look at this building. Go and get them round. So I absolutely loved it, and I absolutely thrived in that department. Going and both leasing, so basically being like a letting agent for big offices. I mean, you basically, people say, "Oh, I'm a chartered surveyor." I was like, "Yeah, no, mate, you're a glorified estate agent." Let's be honest. But the thing was, I loved it, and there's nothing wrong with it.
Absolutely.
But call it's just like I hate the sort of aloof, grandiose titles that people give themselves. No, mate, you're an estate agent. Just admit what you are. And but I loved it. I loved selling. I loved the meeting people, and I also did tenant rep work as well. So I'd go and put together lists of potential buildings that tenants who were looking for space could go and occupy, and we'd go and do viewing tours, often in either in the pissing driving rain, or whether it was, or you'd be baking hot and you have to wear a suit, shirt, tie, black shoes, everything. In a suit where I've always had an ample posterior, in suit trousers that are never more than a badly timed moment of sitting down from splitting the seam of the back of it out. So it was great fun. I did that for about a year and a half, and then I actually had to have 2 goes at passing my surveying exams, my RICS exams. So, but I got it second time around. I feel like I have to do everything good in my life and my career twice. So I qualified, and then I got a move to the West End investment team at Cushman. So back to Portman Square, I went, and then we got to buy and sell big and fancy office buildings and retail buildings all over the West End, and I learned a lot. I actually did a deal which was pretty unheard of for someone who was basically newly qualified. I did a £5 million deal within 3 or 4 months of joining that team. I don't think my bosses liked me very much, because what they wanted was a bag carrier and someone who was going to write brochures and do measurements and do all the grunt work, and just maybe being naturally entrepreneurial. I mean, I didn't touch on it, but I even had that sort of thing at school where I'd buy all the cans from the school tuck shop, corner the market, and then sell them all to my classmates for a markup. So it's always been a little bit in my blood. But yeah, it was, that entrepreneurial spirit. I was getting out, trying to meet clients, trying to get some deals off market, and things were going quite well. But I don't think my bosses liked me very much, because I wasn't doing what they wanted me to do, which I sometimes have to remind myself of when I have a maybe slightly more free-spirited colleague at Avamore these days. I can think of one right now, actually, where I probably have to be a bit more patient, because actually I was a lot like that myself. But that was all going quite well until Northern Rock. Obviously, being a Geordie, that will be very close to your heart. Maybe not in the good way.
Yeah.
And then Lehman Brothers, but between Northern Rock and Lehman Brothers, it was a pretty painful time. The commercial property market was dead. Very few deals going on. I was so bored. I actually managed to look at every single page on the BBC website. probably wasn't as big as it is now and full of features as it is now. But it wasn't a page on the BBC website I hadn't read from 9 till 5:30 one day, because there was literally nothing to do, and my bosses couldn't even tell me to do something. I'd done everything I could do to be proactive.
The phones weren't ringing, I remember.
Phones weren't ringing. And, I sort of saw the writing was on the wall about 6 months before Lehman. So I started to try and find jobs. But again, the jobs market was dead for the stuff I wanted. And then, ironically, post-Lehman, an opportunity came up at a private equity company and their real estate fund. Someone I knew through my city agency days was going to be my boss. So I had and also did chemistry as a degree. So which made
there's a bit of chemistry between you then.
Well, that was probably where the chemistry ended. I might add. I think she'd probably say the same. and so I ended up really kind of against the grain, getting a really good job in pretty much the worst time in the market. And about a week before my notice period ended. At Cushman & Wakefield, they announced a wave of redundancies, and I can assure you that if I hadn't found another job, I would have been, because my bosses didn't, I wasn't doing what my bosses wanted, I reckon I would have been on that chopping block. So, long story short, I sort of smelled the danger, found an opportunity, and I took advantage of it. But, I was definitely proactive rather than reactive, whereas if I'd gone looking, probably 3 months later, I reckon I'd have been stuffed.
Yeah. Well, it's interesting you've got that entrepreneurial spirit to you as well, because the longer I do these interviews and the older I get and the more people I speak to, I do realize that you've either got it or you don't. And that streak usually comes out early in people's lives. There is that common denominator. And I do like what you said about because I start my career as an estate agent, not a RICS one, just a regular one. But there is a lot. It's pretty much the same job role, but there is an element of additional prestige once you're in that RICS kind of qualification and you're doing a certain caliber of agency work. But at the end of the day, it is more or less exactly the same. But that is interesting. There's not many people that will admit that or say that out loud, so I appreciate you doing that. It helps me in my ego. And I always wanted to be an estate agent growing up as well, which a lot of people laugh at to this day. But I loved it as well. I really had some great days, So once you got into the private equity fund space, then how did you evolve to getting into the lending space?
Yeah, so as you can imagine, post Lehman's, going into a private equity real estate fund, a fund that had its vintage. The fund vintage was 2007. So what a time to be going out and deploying like loads of like the seed deals. I mean, it's just timing in the market. And the irony is though those prices probably 6, 7, 8 years later probably would have looked fine, but they took out they bought these big assets, top of the market, super highly geared, very expensive interest rates as well. Acquired on the basis of like 5% per annum rental growth assumptions, yield compression, the whole 9 yards. It's kind of like, you just do a goal seekers. I think they just went on Excel and let's do a goal seekers to how do I hit a 20% IRR or whatever. So there was maybe some bad underwriting of deals, but what followed was banks that wanted their money back or wanted to get paid down to comfortable levels, and assets that were hugely overgeared. And so in the 2.5 years that I was there, I was involved in something like £400 million worth of refinances and restructurings of these commercial facilities. And I learned a lot about lending, banking, covenants. I didn't do any actual deals in terms of acquisitions or anything like that. Did some asset management oversaw the asset management of some of these assets. Some of the lending involved speculative development facilities. So the largest deal that I did was an £89 million speculative development facility of a development in the West End, which ended up being a success actually, and ended up selling for over £200 million in 2015. After I'd left,
Mixed use commercial.
Mixed use, yeah. And actually, I said I didn't do a deal. I ended up, I actually was involved or ran the selling of 10 of the units to a housing association. That was a painful experience. So very much the tail wagging the dog. A £3 million deal out of a £215 million development. That was quite interesting. So I learned a lot about development finance in that time. But it takes its toll. I was doing 14-hour days. My son was born, and I've sort of hit a bit of a wall, had a bit of a breakdown, and my father-in-law said to me, "Look, why don't you come and work with me?" So he had a healthcare business, had a property portfolio. I helped him exit that healthcare business for a really good price. So ran the M&A process for him, and then we sort of repositioned the real estate portfolio. So that actually went really well. Bought and sold really well. Bought a load of office buildings, which this was before PD was like a permanent thing.
Yeah.
So we bought those off really good prices, and then either got planning or flipped those sites to developers when PD became permanent. At one point, we were fully invested, so effectively I started doing a bit of consultancy work to try and just keep myself busy, ticking over, maybe earn a few quid on the side. So I was advising some developers on how to raise money, actually mainly equity, but then I started to learn about bridging and development finance and help people go and source bridge and development finance on the side. And then was working with one particular client who still talk to and work with to this day, 10 years later. And he needed a second charge on a mezz loan on a development in the prime central London development that him and his partner had done. So I met Zahair. He was looking. Zahair just left Goldman's. He was looking to deploy family capital into bridging. So I said, "Look, here's this deal. Do you want to do it?" And he said, "Well, I'll tell you what. I'll do it if you go 50-50 with me." I said, "Okay, let's have a look at it." Anyway, so we ended up trying to negotiate a deed of priority with Close Brothers, which is basically like the rules between a junior lender and a senior lender, if you don't know what that is. And generally speaking, the senior lender goes, "Yeah, this is what we want," and this is what the senior lender normally gets what they gets their way, which is quite funny because we're working on something like that together at the moment, aren't we?
We are on one deal, one particular deal, exactly.
And of course, Zahair and I were like, no, this is what we want, and we sent a heavily marked up document to Close Brothers, and I'm sure Close Brothers, the underwriter at Close Brothers, had a good laugh and said no. So we didn't do that deal, but Zahair and I sort of found that we saw things from a very eye to eye. We had very complementary way of working with things, and within a month of meeting each other, we incorporated Avamore, and within a month of that, the same client, by the way, we did a bridge deal. So
within a month of meeting each other.
Within a month, we'd incorporated, and then within a month of that, we'd closed a deal which made us a good chunk of money, and away we went. And within the first calendar year of Avamore's existence, we did something like £20 million worth of lending. I know it sounds like a lot. And then
that's decent for your first year from a standing start.
Absolutely, I think actually was probably year two was like as a football fan you understand second season syndrome.
Yeah.
Well, we definitely had second season syndrome. So towards the back end of 2017, we were I think on a bit of a knife edge actually in terms of Avamore's long term existence. We did a deal in Bristol in a place called Brislington. It was a £5.5 million PD development. It almost certainly wouldn't be able to be developed now post Grenfell fire eggs because it had some very dodgy cladding on it. But we did that. That deal was a success, and within 6 months, 9 months of that, we got our first institutional funding line, and I suppose the rest is history, really.
So that first 20 million was pulled from, because for all those people out there that don't understand how the modern day lending market works, a lot of people think, well, this comes from a bank, and the bank people put deposits in. I'm not even sure that they know exactly how old that works, but certainly since 2008, there's a lot of private lenders similar to Avamore have been set up, and they can be done in different ways. So it can be own funds, it can be family office funds, it can be institutional. And you just mentioned that you just were able to secure your first institutional. So up until that point, how are you funding deals?
We were funding deals through we're funding deals mainly through mine and Zaher's family offices. So we had a reasonable amount of family capital, but not enough to kind of go. You were never going to be able to become £100 million a year lender. With that depth of capital. We then also encountered a few other private lenders who were working with some of our competitors, and so we approached some of them and we offered them good terms to basically co-lend with us. So we were a very attractive proposition because we weren't looking to take much margin off them, and we were putting our own skin in the game as well. So as a consequence of that, attracting capital to come and work alongside us and go into deals was actually relatively easy because of our backgrounds as well. Obviously, Zaher was at Goldman Sachs, working in M&A. My background in private equity real estate, plus the fact that we were putting family money into it, it meant that we were a pretty compelling proposition from a funding perspective. So, needless to say, we actually didn't have too many issues with getting funding. Probably the biggest challenge was actually pricing. That money was not cheap. It was probably the funders wanted, anywhere between 10 and 12% per annum of interest rate in a market where the pricing
10
was
or 12.
Yeah, and at the time when the market was starting to get much cheaper. When we started Avamore, pricing a bridge loan below 1% a month was considered to be cheap, but 3-4 years later, cheap was considered to be 5 to 6%. So because of the weight of institutional money that came into the space, I mean, even the terms from the credit funds that we were talking to when we started, they came to us at 8-9%, and then they were down into the sixes by the time we actually probably pre-pandemic or just around the time of the pandemic. And that was just driven by the weight of money coming into the market and just the competition that was out there.
And how does it affect your? I mean, I guess there's two questions I've got. The credit process. A lot of people think that lenders have this mysterious process in the background, and some people talk about the credit committee, and they think that these people in dark suits and dark rooms that make these decisions that are shadowy people and all that. And then I know that once you take on various funding lines, that can affect your credit process as a lender, putting capital out into the market. Did you find that your process has changed? And for those that don't know, what is the process for the credit? This episode is brought to you by Avamore Capital, one of the UK's leading specialist property finance lenders. They work with property developers and investors, and whether you're looking for ground-up development, heavy refurbishment, a bridging deal with added complexity, Avamore brings a common sense approach and real flexibility to the table. We use them at Merry Oaks. We're really, really happy with the work that they do. And if you're interested in funding your next project, please check out the show notes. The link will be below. Reach out to them and start that conversation today.
Process for doing a development loan from a lender's perspective, and obviously you'll know this obviously from your own time, but for the benefit of your audience who don't know, generally speaking, you have an initial view of the deal. You do an initial review. Can be quite high level, can be quite detailed. It's up to you. Generally speaking, the lesson we learned is don't go too detailed because you'll end up spending loads of time looking at deals that you're never going to do.
Yeah.
So you do initial review. You make a proposal to the broker or the borrower, who, depending on how you've got the deal. And if they like the deal, you then kind of firm up your terms. You appoint a valuer, and if it's a development deal, a monitoring surveyor, to give you an estimate of what it's worth and what it's going to be worth when finished, and what's going to cost to do the works, and any other key due diligence information you need to do around the construction. If those numbers come back okay, in line with expectations, you go to legal due diligence. In the legal due diligence, you'll basically get a report on title from your solicitors, who will say yes, the property is what you think it is. They'll look at the valuation report, they'll look at the monitoring surveyor's report, see if there's anything else that they need to highlight and flag. You'll prepare security documentation, and then you'll write the loan. All being well. And if there's any issues, you add covenants clauses. You'll obviously do some background due diligence on the client. You obviously want to see if the client has been a naughty boy in the past, or naughty girl in the past. Whether that's insolvencies or anything more nefarious. We once had a guy who was linked with a Lithuanian cigarette and people smuggling gang.
Holy shit!
We were like, yeah, this is because, and I think particularly when you're, ironically, it's particularly bad when you're a private lender because if they borrow from Lloyd's, they're not going to go after the underwriter. They're not going to not try and pay Lloyd's back. Lloyd's just going to appoint a receiver, and they can't go and apply pressure to Bob in underwriting. Whereas if you're a private lender, obviously they can find out where you live, and they can make your life pretty unpleasant. So, life's too short to be dealing with nasty characters, and particularly so if you're putting your own family money at risk. So in effect, that's sort of the process. And if you find out something bad about someone, you then say, well, either you have to do that, you create some conditions for them that make you comfortable, or you just elect not to lend. I think our process was, as a family lender, was actually really stringent. We had someone come and do a review of a file audit and do an underwriting review in conjunction with Westcor, who are title indemnity providers. And he said his conclusion. This is someone who ended up working for us for a short period of time. Very experienced individual. He said, "I'm amazed you've even done a deal." And this was in mid-2017. Wow. Because our underwriting processes were really tight and really stringent. Of course, we were ultimately deploying family capital. And the last thing you want to do when you're having Christmas dinner or Sunday dinner with your father-in-law is that you lost money because you were stupid and you did you did something bad. When that's your grandchildren's inheritance and his legacy. So on that basis, we had to be very, very stringent. So actually going to a institutional model didn't create any additional hurdles for us. I think a lot of the time private lenders have quite can sometimes have quite slack processes, and then they go down the institutional route, and all of a sudden they have this whole raft of hoops they have to jump through to be able to get the money from their funders. But in our case, actually, it was the opposite. In fact, one of our funding partners, when we did the due diligence day with their founder, who's an American guy, he actually fell asleep because I would always say to Zaher, I said we must always bore funder partners with our competence, and we were highly successful on that day.
Evidently so. It's so thorough. There's and then we do, and then oh my God, when is it going to finish?
And it was about I was expecting us to run until about 5 o'clock that day. We booked a sort of windowless, airless meeting room, and by about 2:30 they were like, "Yeah, we're good. We've seen everything we need to see."
This is. I mean, do you love lending?
Yeah, I mean, genuinely love lending. Yeah, and I think that there's our attitude is always yes. It's yes unless we can't. And we're in a sort of nice position where, because of the way that we're funded, we operate on what's called a forward flow model, where we originate loans on our balance sheet and then we sell those loans fairly immediately onto our capital partners, and then we manage the loans on their behalf. And so what that means is, and then some of the ways they fund. One of them in particular uses a securitization structure. So effectively, those loans will then get sold on again to institutional markets. But I guess what that means is that we almost have a near endless supply of cash. So a lot of lenders who operate more of a balance sheet model, they effectively have equity and then they'll have bank debt that will sit behind that. So they'll effectively leverage their loan book. But that means that effectively the amount of money that they've got available to lend is fixed. Which means that once they get close to being fully deployed, they'll start to become much more selective about what they do. Whereas in our case, actually, we should not say we're not selective. We want to do good deals, but we're much more flexible with what we do and who we want to lend to relative to a lot of our peer group.
One of the things that comes up regularly for development finance, bridging, any type of lending really, I guess, and property investment development is valuations.
Yes. Oh dear.
I'll let you take a step breath. You've been in that space doing valuations, buying and selling, doing leases, etc. So you kind of understand how that market works. But when it comes to lending and investors and developers' expectations, there is a school of thought that there is no such thing as a down valuation. It is simply the expectations of the borrower that are way out, and therefore the valuation is what the valuation is, and therefore the down valuation is a misnomer. At the same time, just from my own experience, I literally did it recently, a few months ago. I had 2 valuations on the same building. I knew that it was probably going to, because it's not an exact science. Human beings come up with different numbers. So I paid double the amount that I should have done in the hope that one of them would, I was hoping on this occasion, out of every single time, they are going to come far apart. And whichever one's the highest one, I'll just go with that because I want to pull out more cash. And it was a smaller building. One valuation came in at 475. The other one came at 395. And I've seen, that's 18% difference or something, but I've seen larger ones than that, I've seen small ones than that, and then you've got all the whole 180-day versus 90-day valuations and stuff. From your experience of being a lender, because you have to rely on these heavily, how much do you do internally as a team? How much do you rely on the team to do their own checks? And how much do you rely on valuers? And how much influence do you have, if any, on what valuers might come up with in the end, especially if you really like a deal that you want to do?
We're finding valuers very frustrating at the moment. The question you asked about, how much work we do internally on valuations, we've actually built a really impressive tech stack. I remember when we had a drink
yes.
at the end of the summer, I was telling you about it, and actually we've come along a huge way since then. We've got three in-house web developers or tech developers who've helped us build out the tech stack. But one of the key parts is an in-house valuation tool.
Amazing.
Which means that we now have, with a good degree of confidence, and most of the deals that we look at have a good sense internally as to the valuations. So really, the valuation reports and the monitoring surveyor reports, although to a lesser extent we need to rely on those a little bit more, because I think we're a bit less confident about our own internal. We've effectively got access to the BCIS data, and we do our own internal build cost estimates as well. But just the data is probably just not quite as good as the valuation data. So we form our own opinions, and we have a good degree of confidence about values for the schemes that we're generally lending against. So really, those valuation reports are mainly for the benefit of our funders rather than for ourselves, because we already kind of know that it does help. Obviously, having a valuer go to site. Let's say a developer tells you that he's developed 10 units, and actually he's only developed 8. It's good to have a valuer go out on site and actually count them and check them and measure them. Exactly. So you do still want that component of it. But for us, really, the valuation is, broadly speaking, in the absence of fraud, there for the benefit of our funders. And so consequently, if we've made a decision that we want to go ahead and lend off the back of a borrower's estimate of value, it by extension, we sort of feel we're hoping that the valuation comes in when the valuation comes back, and if the valuation doesn't come back, and we've got our own internal data that suggests the value has been too negative, and we're talking more than 10% out here, we'll try and go into bat for the client at the moment and say, no, we need you to come on, Mr. Valuer or Miss Valuer, kind of sharpen the pencil. Let's, look at this comp, look at this comp, look at this comp, and we're regularly having that argument with them. And the thing that frustrates me at the moment is that, and some valuers are accommodating in that regard, because ultimately, if we don't make any money if the deal doesn't close. You as the broker don't make any money if the deal doesn't close. The client doesn't make any money if the deal doesn't close. The only people who make money in a transaction at the moment with certainty are the professionals in there. And I think the thing is, we have to send a message to those professionals, which is, if you're consistently creating conditions that lead to deals dying, then we're going to have to work. We aren't going to be able to work with you, because we're not going to make any money here, and we're in the business of making money at the end of the day.
And when you talk about those professionals specifically, we're talking about people like solicitors and surveyors.
Solicitors and the two types of surveyors that we mentioned, yeah. And I actually think the monitoring surveyors, it's famous last words, at the moment actually aren't being too bad. 18, 24 months ago, that was a different story, because bill cost inflation was kind of going crazy.
Yeah. Agree.
At the moment, solicitors are really, really winding me up. Service levels are poor, very slow, and fees are getting out of control.
Why do you think that is? Because it's across the board, and there's no sign of improvement. It's gotten worse, especially since COVID, exponentially. What do you attribute that to?
I think it's the thing to bear in mind is that our solicitors typically working on generally a fixed fee, unless the requirements blow out of proportion, and so I suppose they're not to some degree they're not necessarily incentivized to work quickly and effectively. They're effectively looking. I think what a lot of them do is they'll try and take as many instructions as possible at any one time, and then just like dip in a bit here and there and here and there. And there's no real incentive for them to actually get the deal from A to B. And the moment you ask the solicitor to go, right, actually the client wants to complete in a week, they go, well, that's going to be double. And you're like, well, it's the same amount of work at the end of the day. And that's the crazy thing. It's like we are, if I said to you, Sam, when you think of a bridging lender, what's the one word that comes into your mind when you speed? Correct. Yeah. We're in a service industry business. You're a lawyer. You're a lawyer. You've courted the business of a bridging lender.
Yeah,
I know
literally.
we obviously do development, but effectively of a bridging lender. Yet the minute that we ask the lawyer to operate with a degree of speed, they go, "Oh, okay. Well, that's going to cost you." It's like, it's insane. I think there's also there's probably an element also of a lot of these solicitors are still working from home, or working from home a lot, which I don't think helps with productivity either. I think there's a lot of calls. They end up getting stuck on a lot of calls, and I think you probably know as well as I do that. I know you're trying to get people working together in an office more regularly. When you're working remotely, what happens is if you want to get together, you schedule a Teams call. And that Teams call is automatically, when you put it into Outlook, it's a half hour call. And of course, something that probably would have been 5 minutes if you were sat next to each other in an office, you've just expanded that task to fill a half hour slot, which would have been completely unnecessary. So again, all these things feed into, I think, a reduced level of effectiveness and efficiency.
I totally agree with you all of that, and I do remember when we met and we started talking about tech and introducing tech into systems, and how has the AI revolution supported you and enhanced you, or is it scaring you in any way? Because, well, I guess from a lending point of view, in terms of what you do, the AI can pretty much underwrite a case, if not straight away right now immediately, but in the next few years, it can probably check out a location, it can look at the pricing, it can probably write up a report on its own. In terms of AI and tech, I know you're kind of into that space. a lot. Do you think that it's a net positive? Are you scared that it's going to take away jobs, or?
I suppose as the owner of a business,
You're hoping it takes away jobs.
I wouldn't say. I suppose I don't have a personal threat on that side, but I do think. Okay, so first of all, AI. I think AI has been a net positive for us. I think it will continue to be one. I think that we will be able to. We'll be able to do. We're looking to do some very, very cool things with AI. And also sort of machine learning. We're already using it at the front end. So we've got although it's still not used widely by our relationship managers, we actually have a bot that if you forward an inquiry to the bot, it runs it through GPT-4, and then it generates a set of indicative terms on the back of an inquiry email if the inquiry email has the right level of information. Because that, so if you want terms really quickly, you can get terms from us like indicative terms in the space of 90 seconds. Sometimes it still doesn't pick up things exactly how you want them to.
Yeah.
But it's something that I think we'll revisit and we'll enhance that, and we'll actually make it even better. But we're using AI to review valuation reports, to review monitoring surveyors reports. We're using and then also we'll use it for reports on title. And then ultimately, we're probably 6 weeks away from what I would say front to back, end to end semi-automation within the business. To the extent that we'll have automated writing of credit papers based on all the information that's fed into the system. So one of the things we had to do is start to feed all the data that we have in the credit paper through AI with the correct prompt to effectively tell us, whether this is a deal that we should do or not, and then we'll start to train that and develop that. So there's definitely a lot of potential for that, but I think that AI in the context of what we do at the moment, it's very much a people plus AI. For example, at the front end, as a broker, there's no way you want to just deal with a faceless robot. You'll generally want a person that you can talk to and connect with and speak to, and that would be a fairly universal experience that we'd see for most of our broker partners. I think then on the decision making side, particularly in development finance is very nuanced. And it's very specialised. It's not like resi mortgages, which can be much more cookie cutter. So as a consequence of that, you still will want, and I'm sure our funding partners will expect, that we will have some element of manual underwrite regardless. But what we want to do is we want to use the technology to give the team leverage, so that we can. It's rather than cutting headcount, it's using the headcount that we've got
to do more.
That's what it ultimately boils down to. And so consequently, that's sort of very much the direction of travel that we're in. I think that we've made amazing strides on the technology front, probably more than I even dreamed of being able to do 12 months ago. Which is, and it's what's quite exciting is that it's starting to come to fruition, really quite nicely. And so I'd say definitely, I think we'll be V1 by mid-July. I think we'll be V2 by Christmas. So V2 will be like where we're improving the bits and bobs that we've been doing, and then, filling in the gaps and the blanks. So we're right now, we're kind of what we call in tech speak, we're minimum viable product.
Yeah.
By Christmas we'll be, we'll have beta tested pretty much everything. We'll have added new packages and features, and by a year from now, I think we'll look back and it will all be unrecognisable. So it's very exciting, and I think the most important thing is that you as brokers, borrowers, we now have an automated. We effectively have when you appoint valuers and monitoring surveyors, we now have an automated chasing system. So once the quotes go out, the valuer puts their inspection dates in, their quotes in, and it will chase them So we say, right, you said you were going to inspect on this date. Are you,
That's cool.
Have you been paid when they've gone out? Have you gone out? Great. When they've gone out, it's like, right, you said you'd have a report to us a week after the inspection. Where's the report? And they'll just keep getting chased until it gets back.
Which is great because it also puts me out of a job, actually, because that's the what's what we do a lot.
No, because what happens is if the client doesn't pay, you get chased.
I get chased. Yes, somebody's doing. It's great though. You know what? Honestly, it's really good to hear that people are doing this sort of thing. Lenders are doing this thing proactively because you're absolutely right. We don't get paid until the deal happens, and so we're pulling in the same direction. And sometimes that doesn't always necessarily come across in a process. But I certainly have experienced it with that Avamore, which is great. The interesting thing that you said was you have to feed the AI. The relationship managers need to feed the essential information for the developers and investors out there, especially the ones that are maybe doing smaller stuff and looking to grow and to do larger deals. What is that essential information that they need to be putting in? Like, what are the things that you're looking out for?
Right. So we are. And looking back to the time, 7-8 years ago, when sometimes I didn't have the team to support me. I'd have to run the cases myself, right?
Yeah.
So I'd get an inquiry from a broker, and it would be, sometimes you get like one line, and then you either get one line or you get War and Peace.
Yeah.
And when I get the War and Peace, I'll be like, look. Listen, I don't have, my analyst is sick today, or we just fired our analyst, or, fill in the blank. So, right. Can you, these are the key pieces of information. The first one, it would amaze you how often you don't get this. What's the address?
What address?
What's the address? Please give me the address, okay? Number 2, what's the market value of the property? Well, no, you could say number 2, what is it and what is it and what do you want to do with it? Number 3, what's the current market value? Number 4, if you're going to do some works to it, what are you going to spend on it? And number 5, what's it going to be worth when it's finished? If I have all those pieces of information, I can price up a deal. I can give you an indicative pricing. Now, to go to this, that's the first line of kind of initial basic appetite. Is this a deal that we'd support? Okay, if we would support it in principle, here you go. I'll give you 75% of the market value on day one. I'll give you 100% of the build costs, and I'll give you up to 70% of the gross development value of the project, subject to loan to cost. Like basically, are you putting in 10 to 15% of the total costs into the development? I say you. It could be Bob from the golf club, but some combination of you and Bob from the golf club. So that's what I need to know. The second phase of due diligence is a bit more detailed because you might want to say, right, could you give me details of the planning permission? Can I have details of your assets and liabilities? Because particularly if you're supporting a development, is right. If one thing's for certain in development projects, something's going to go wrong, and when something goes wrong, that's probably going to cost time and money. Have you got an asset base or an income base to support the scheme if you need to put more money into the deal? Because a lot of the time we're not going to be able to do that without unless we take additional security like a second charge on one of your assets. We want to know we also want to know your experience. Okay. Now we're quite flexible on experience, as you know well, Sam. But we do want to know if you want to build a £10 million construction project, and the most development experience you've got is a light tart-up of a 2-bedroom flat. There's a bit of a mismatch between what you've done and what you're planning to do here, and that doesn't really portend particularly well that the project that you're planning to do is going to be particularly successful. So that's a key piece. That's also a key piece of information. But with all of that information together, that sort of phase 1 information and phase 2 information, we can then give you a credit-backed, subject to due diligence offer to lend. And really, all being well, if the due diligence checks out with what you think it's going to be worth, what you think it's worth, and what you think it's going to cost to do, and there's no issues with the title of the property that you're either buying or you own, you're going to get the money. That's the principle of it.
That's very well put. Now, if you've got a deal in front of you, what's more important to you? Is it the numbers on the deal, so a really profitable deal, or is it the developer that's delivering it? So would you rather have a stellar deal with a borrower that, yeah, I think they're going to do it, but I'm kind of hoping that they'll do it really well rather than like dead uncertain? Or would you rather an average deal where you've got like absolutely brilliant developer? I know he can close it with deliver it with his eyes closed.
I'd take the average deal with a brilliant developer, generally speaking, because I know that underwriting process is going to go a lot smoother, be a lot easier to do. It's going to be a lot less painful. They'll pay their solicitor's undertaking when we say it. They'll pay for the valuation reports, the monitoring surveyors reports when they say they'll do it. And yeah, okay, the margins might be a bit tight, but our position is fine in that one. Having said that, though, we're gearing ourselves up as an organisation. I mean, one of the upsides of having a lot of working out a load of loans that have gone non-performing is you develop a lot of experience and you learn a lot about construction. And we're developing the expertise now where we could almost work with any developer and help them see a development through from start to finish. So if you ask me that question in 12 months' time, I might say to you, I actually don't care about the developer. As long as the scheme's good enough, we'll be able to help the developer structure a professional team around them so that effectively their own experience is irrelevant.
Yeah, no, that makes sense. It's really good to have lenders out there that are supportive and that are pragmatic, because at the end of the day, like I said, you've got to get the capital out to be able to make any money. And if you can see a way that we can make it work, any support that is always appreciated. I think technology is really changing things. So, the some of the questions that I'm asking now, the answers that I would have got 18 months, 2 years ago, what the answer I might get today, and then the one 2 years from now are completely different. Can't remember a time that everything's quite been like that. But should borrowers go to a lender directly?
No.
Why?
That
was quite a, you've thought this through before.
Well, I had this conversation on my own podcast recently. So,
who did you have it with?
That was with Sam Norris.
Okay.
Game of Loans, Sam Norris.
Yes, another good broker in the market.
Now, basic premises. Merry Oaks will be doing hundreds of deals a year. You have your clout, your buying power with a lender is so superior to a developer who's going to do at best 3 to 5 loans a year. So when something goes wrong or there's a problem or a view needs to be taken, if you're a developer working directly with a lender, the lender's like, well, they're less likely to go out of their way to help that client, because that client isn't as valued to that client relationship isn't as valuable to them as a broker relationship will be. That's why a broker. So whilst in theory there is a slightly increased cost of working with a broker, it's well worth it, because especially if you're working in development finance or you're looking at a bridge, a deal of a lifetime bridge, or a refurb deal or conversion deal. The extra 50 basis points in fees that you might end up paying working with a broker is worth so much more than not getting the money. So why would you not? And frankly, it might be that the broker can actually net the broker's involvement ends up being cost neutral. So, fundamentally, why wouldn't you work with a broker?
Yeah, no, I agree. I think overall, it's a fractional, marginal cost of the entire cost of a deal. I'd be happy to agree with you, considering I have a vested interest.
You would think that I'm coming on a broker's podcast. Well, of course he's going to say that, but the truth of the matter is that direct clients, working with clients directly, isn't always cracked up to be from a lender's perspective, because actually a direct client, although in theory we could maybe get slightly better economics for ourselves from a deal because we're not having to pay procuration fees. The thing is, a developer doesn't necessarily know how to package the deal for a credit committee. So what happens when you deal with a developer directly is it's inefficient, but also, the broker can also act as a filter. So if a developer is upset and they throw their toys out of the pram, there's no filter when they're doing it directly to you as a lender. And by the same token, whereas I can have slightly more grown up conversation with the broker about why we do or don't want to do a deal, or why we have to change this or that about the terms. Whereas we can't, you can have slightly more emotive conversation, emotional conversation with the developer in those circumstances. So it's it does genuinely make more sense from a selfish point of view as a lender to do that deal directly, to do the deal through a broker rather than direct with the developer.
Yeah, I completely agree, and I think that that's a testament to the market and the way that it is structured in the grand scheme. Like most lenders work via brokers. In fact, some lenders will only work through brokers, especially the more bigger volume lenders, right? So I do agree with that. So in terms of the next vision for Avamore, do you have, you're approaching $1 billion in loans, which is like unbelievable by anyone's standard. Do you have any future vision of where you want to take it, especially given all the kind of technological advances that can, with the same team, hopefully propel you even further?
Yeah, I think the key thing is we've gone through a bit of flux in the business with basically our entire senior leadership's been turned over in the last 12 months. But we've got two really good new managing directors in place, a really great middle upper management team as well, supporting them. And so the future looks quite exciting. The technology is a big unlock for us, but technology can't do everything, can't do everything for you. And one of the first things that we've got to do is, we're working really hard on the culture within the business. I think some of the things that got us to where, got us to a position of greatness in the market were lost over the last couple of years. With me and Zaher maybe not being at the coalface all the time, and certainly not the intention that we'll be at the coalface, for the rest of the time. That's why we've got the two managing directors in place. Obviously, one of whom you've worked with previously, Jacob. Greg is someone who has run his own lending business, and we've known him a long time. Very, very excited about what the two of them and the rest of the management team are going to be able to achieve. The technology is naturally a big unlock. It will reduce the cost of doing a deal for us enormously, because I'll give you an example. At the moment, to write a credit paper in a Word document takes our underwriters a day. Let's just say anywhere between half a day and a day, right? So you extrapolate that across the number of deals, what it costs an underwriter, just costing an underwriter salary, forget everyone else involved in the transaction. So the less time we have to spend on each individual transaction as an organization means that we can spend more time on more transactions, which means that we have a minimum transaction ticket size of, let's say, £500,000, 250k. We can do smaller tickets. And it opens up different markets for us. So at our peak, we were doing £180 million a year on a rolling 12-month basis, actually 185. I think, we've already got the team to do anywhere between 250 and 300 million a year. I know Zaher wants to get to £500 million. The development finance market is big enough to, we can get to that level. And, I think development finance market there's not very good data on it, but our estimates is about 19 billion a year done in development finance, or construction finance or some component. So we know that we're not, even if we get to that level, we're barely more than a rounding error anyway. So I think that's very much possible. It very much fits with our vision as well of wanting to support SME house builders. And if we can do 150k, 200k development loan for a couple of guys in the northeast wanting to build a couple of semis or whatever, that's great. But because there's not that many lenders who will do a construction loan of that size, because it's not at the moment. We've got to manually underwrite all of that. It's not very scalable. But we're obviously doing work that will enable that to be much more scalable. And then the hope is that those guys or girls who are doing those small construction projects they can grow with us. And look, the other thing is the more we do, the bigger we get, the more capital we attract, the cheaper the capital is. It means that the cost of the finance component of house building will continue to fall. Because ultimately it's a competitive marketplace. Those cost savings, those efficiencies will feed their way into the market. Now, some cynically might say, well, all that'll do is feed into the cost of the land, and I don't entirely disagree with that. But in the short term, we hope that we will make it cheaper for the consumer. Not that they are consumers; they are businesses, but but ultimately they are our customers, and we want that. We want to be as cheap as possible whilst still being profitable and benefiting the wider housing industry.
I can tell just in the tone and the way that you talk that there's an element of passion there. We do have an affordable housing crisis in this country, and some people say you've got to tax the rich, and some people like myself, I think you've got to increase housing supply. I think that's a better way of doing it. Neither is easy, but certainly by having funding available to be able to work on deals in the Northeast or whatever, wherever necessary, bringing that cost of capital down and improving efficiencies. I think half the problem is, I always say that as brokers, we'd make a lot more money if we can just get the deals done quicker. The red tape or the age-old processes that we've got, like things like the land registry not being digitized yet, just slows everything down, and that causes the friction and money. I always tell our team, like, money loves speed, it hates friction.
Well, time kills deals.
Time kills
deals. I'm gonna get that painted on the walls at Avamore Towers, because nothing kills deals like time. Why does it take 3 weeks for a local search to come back? Again, solicitors, they've now, I don't understand why it takes so long for solicitors now to turn around a report and title or to provide replies to inquiries on the borrower side, right? And especially now they've got AI tools, right? I think sometimes the solicitors are terrified of using the AI because they'll struggle to justify their fees. But genuinely speaking, I think that we can be as efficient as we want to be, Sam, right? We'll only be able to move as quickly as the client wants to, and the people, and you're only able to move as the slowest, chess piece in the wider game. That's the end of the story, right? It's like in the house buying process, you could make every single part of the conveyancing process as quick as you want, right? And actually, to be fair, I don't think it's generally quite quick now, a lot of like resi conveyancing. But there's one component, which is the consumer, right? You don't want to move until the start. A family doesn't want to move until the start of the summer holidays, do they? Yeah. Or whenever, like these traditional moving periods, because little Johnny and Jemima, they're in school, and you don't want to move them out of school until you want to do it. You want to move when you want to move, and that might not be for 3 months. And if you're in a chain or whatever, so there's always an element of that feeds into the process. But certainly, we've got to do our bit to make it as quick and painless as possible.
Because the Labour just announced that Keir Starmer said we're going to make sure that developers don't sit on their land. We're going to make them build it. And I'm thinking, I think a lot of people, your LinkedIn feed starts going a bit nuts with everybody complaining about it. But they're also, if a developer, whether SME or even a major house builder, could build a site that they're sitting on profitably, they probably would, really. It's like saturation levels that are usually the key issue, or planning that takes forever.
I would say mostly it's the planning, but there's also that saturation component, right? Which is that volume house builders, they build 75. They might get planning for 2,000 units, but they only build 75 at a time because they don't want to have loads of stock that they can't sell. They've business planned that development scheme on the basis of certain sales prices, if they flood the market with units, they're not going to hit those. They're not going to make any money out of that.
Exactly.
People don't realise that a 2,000 unit housing scheme probably costs anywhere between £2 and £5 million just in planning costs alone, right? It's insane. I mean, there's one thing you didn't touch on, which is that the government also said that they're going to take away part complete development sites, which definitely raised from developers, which definitely raised an eyebrow, considering our sort of flagship product is a part complete development product. Having said that, though, if there was one entity I trust to deliver a part complete scheme even less than a developer who's clearly run out of cash and doesn't know what they're doing, it's the government.
I had a feeling you might say that. So no, and I completely agree. Michael, I could talk to you all day, and there's a lot more that we can cover. We can deep dive into a whole bunch of the topics here. From everything that you've done, and you've had quite an illustrious career, and I think something tells me that there's still a huge things, and the best is yet to come. What is the best bit of advice that you've had along the way so far?
Yeah, I mean, look, it's. I've said it before. I've said it before. I'll say it again. It's a quote from the legendary Zig Ziglar. You can have everything you want in life if you just help enough other people get what they want.
Very good. And what's the worst bit of advice?
Always look out for yourself. No, do you know what? Bad piece of advice. One of those was actually my father. He said to me, my father. He God rest his soul. He had a mixed record when it came to making financial predictions. His parting gift to us was to me and my siblings was investing very heavily into gold with some family cash around sort of 2021. Which we ended up disposing a few months ago at near record highs. So he definitely did well there. But he told me and my wife to lock in interest rates, to lock in for a long 5-year fix, or as long as we could get, in 2007 when we bought our first flat together. So we were stuck on a 6% interest rate when all of our friends were getting like near zero a couple of years later. Yeah. So that was probably the worst. That was probably one of the worst bits of advice. But other than that, no, I wouldn't say that I've ever remembered much bad advice. Put it that way.
Yeah, no, that's a fair point. I think one of those things as well. It's not timing of the market; it's time in the market.
Yeah, exactly.
You are a successful property person. This is all about property people. What are the characteristic traits that people need to have to be successful in property?
Okay, you need to be persistent. You need to be resilient. I think that don't seek perfection when it comes to deals. The thing that I'm realizing is that actually what I like to do typically is I own commercial property portfolio with my family. I regret selling a lot of the stuff we sold 10, 11, 12 years ago. I would rather have maximized that, refinanced it, taken the cash out and gone again. You need to be, the best thing to do, best bit of advice I could give is to just be consistently buying and just keep going, because particularly in the resi space, I know we're not going to see like the crazy house price inflation maybe we've seen in the last 15 years, but we're a small island. We're not building enough housing, and there's and we've got a growing population. So keep buying, keep going, be persistent, be consistent, but don't be impulsive either. I think a lot of people get very impulsive, rush into deals, and then they get their fingers burnt. And I think a lot of the time when you get your fingers burnt, and we see it a lot, working with a lot of early stage developers at Avamore, the guys that come in, they burn really hot, and then they go, and then they're done, right? The last thing you want is multiple insolvencies, bankruptcies. We have sadly had to make people bankrupt. Not too many people, but you've had to make people bankrupt. If you get made bankrupt, that can be very difficult in your sort of onward entrepreneurial journey, and even more so in the property space where there are records of it, and that lenders will see that. Again, doesn't mean that you can't get borrowing. We've lent money to people who are previously bankrupt as well. But certainly don't be,
It makes things harder. I mean, it makes it especially with property, it's a capital intensive game. You're gonna end up needing people to give you some sort of credit at some point or other. So yeah, you've got to try and avoid that. But persistence, perseverance,
and then like relationships, probably above all else. I mean, I probably should have said that first, because ultimately only one person can, it's the same in our game, right? But only one person can ever buy the property, right? And only one lender can ever lend on that property. So, and only one person can be the broker on the transaction. So whether you're in the agency game, whether you're the developer yourself or the buyer yourself, whether you're the broker, whether you're the lender, it's all about, it's much more about who you know than what you know.
Great advice, Michael. Thank you very much for spending some quality time with us. I do know Jacob really well as well, and he's such a fantastic guy. The whole team that you've got there, we really enjoy working with Avamore. And we hope to have many more transactions with you. And as you grow the team, I hope you can come back and share more insights into the world of property development and finance.
No, absolutely. And Sam, thank you so much for having me on. I love what you're doing here. I love the value that you're giving to people, as you know, with my own the Property Funder podcast. That's very much what we aspire to do. So this very much fits in with that ethos. And so, hats off to you. You've got a great team at Merry Oaks. I'm not supposed to have favourites on the broker side, as you well know, but some brokers are equal and some are more equal than others, and you may be more equal than some of those. So
I appreciate you saying that. Interestingly, you said that if you did something, if you'd enjoy doing things twice, we've now done 2 podcasts together, and hopefully many more. If people wanted to reach out and find you though as well, what's the best way if they wanted to talk to you about property development, finance, that sort of thing?
So you can catch me on LinkedIn, of course. You can find me mostly on the internet at property_funder on most platforms. I'm on X. I don't tweet very much. Instagram's probably a good place to get hold of me. If you want to DM me, I'm not going to share my vitals on the internet, because my phone number is going to get scribbled on some toilet wall, but or virtual toilet wall. But yeah, otherwise you can get hold of me through the Avamore website as well.
And I would advise people to go out, listen to Property Funder podcast. There's some big hitters on there, some really good insights. So thank you very much, and we'll catch up with you next time.
Thanks very much, Sam, and appreciate you. Cheers.